You and welcome to this segment of Market Outlook. And today I just want us to have the bigger picture in terms of the market's overview, whereby we are going to look at the snapshot of the review of Q3, how Q3 was, and also we look at Q4. What are we anticipating for this Q4? What are some of the key themes that maybe probably might cause some volatility that really needs us to consider, especially in this Q4 of 2025. Okay, so and to begin this, let me just share my screen. This is a gold chart. We can all see, yeah, this is my gold chart here. So gold has really been pushing up. Okay, but even before we talk about gold, what are some of the key sentiments that we saw in 2025? What went right? What went wrong, or maybe probably caused disrupting in the financial markets? So maybe probably beginning looking at the equity markets, and we saw the equity markets had a very strong quarter, which was basically powered by largely by optimism around the artificial intelligence, technology, and expectations for rate cuts. And in the US specifically, we saw the S&P 500. If you look at the S&P 500 in Q3, so it rose about 8.1%. Okay, so that is S&P 500. So if you look at this S&P 500, maybe probably look at it in terms of 3-month range. So this is how it looks. You can see it's quite bearish. So this is the monthly candle, right? The 3 months candle, because that is yeah, the 3 months candle. And once you look at these 3 months candle, what we are seeing here is about approximately 7.79%, depending now on the broker others, but we are talking about approximately 8%, right, in Q3. And this is actually one of its strongest Q3 since 2020. If you look at 2020, this is where year 2020 is. All right, so 2020, if you look at Q3, yeah, so you can see that it's one of its strongest quarter, all right, since around 2020. And this is basically supported by, we can attribute these from solid corporate earnings that we have seen, and also the dovish central bank tilt, because it's in Q3 that we were anticipating a rate cut, and actually we had that rate cut in September by by 25 basis points. So and that brings us to the aspect of the Fed, because we saw the Fed make that, which is a very key shift, by the way. The first time in 2025 for the Fed cutting the rates, right? So, and we saw 25 basis point rate cut, which really brought in some hawkish stance in the market. But again, if you look at the macro, on the macro side, the consumer spending remains surprisingly resilient, indicating continued demand, even amid the signs of softening in the job markets. And if you look at the labor markets, probably what we are seeing, or the sentiment that we are seeing in the labor markets, it's more of an easing labor market, because we saw jobs push down. Right, we saw the jobs that is we saw the jobs that is the NFP, which is pushing down, right, compared to the previous months, we have been seeing the graph basically pushing on the downside. That is a reduced easing or cooling a labor market. The unemployment is pushing on the upper direction, rising to about 4.3%, which is actually the highest since 2025. I mean, since 2021, we have seen it being the highest at 4.3 since 2021. Okay, so and now, this shift in the economic backdrop was significantly because it changed the conversation around the Federal Reserve policy. So, as the labor market data softened, the market adjusted its forecast to price in a more accommodative Fed, and the multiple interest rates cut before year end. We have witnessed the first one in September 2025, like I said, 25 basis points. We are still looking at a potential of having two more rate cut before the end of 2025. Okay, so therefore, if you look at it in the market's view, what you're talking about is that the slowing job growth wasn't really like a sign of a recession, but rather it acted like a catalyst for the Fed to resume its rate cut cycle. Okay, so and uh, the question that was really lingering was when, not if, the Fed will deliver the rate cut. Of course, we saw those more pressure even coming from the current president of the United States, that is Donald Trump. Okay, so if we talk also maybe probably a closer look of the Fed. Okay, so what really happened is that. In its late July meeting, we saw the rates being held steady. Okay, and Jerome mentioned a solid labor market and lingering inflation risk, of course, attributed to the upside. I mean, a sticky inflation, which was attributed to the tariffs. So, however, we saw as we progressed on, we saw the outlook change, and in his Jackson Hole speech, if you remember very well, the Fed Chair Jerome Powell laid the groundwork on a September rate cut, and actually he delivered that. So he noted about the monetary policy appearing restrictive and said softening labor market data might justify a rate cut. Okay, so despite inflation actually being above the 2% target. So these remarks reinforced the expectations of a September rate cut, and we saw that happen by 25 basis points, again supporting that. So right now you're talking about 4.25%, and we are expecting probably another two rate cuts maybe by the end of 2025. Okay, so and in the September press conference, the chair for the Fed, Jerome Powell, framed the move as a risk management. All right, it was a risk management because describing it as a proactive step to keep the economic expansion on track rather than concerns about recession. So the central bank updated its policy forecast basically to include two more rate cuts before year end, like I mentioned, and therefore with the potential for more in 2026. Okay, so another key theme that really dominated the markets in 2025, I mean Q3, was the artificial intelligence. All right, so the artificial intelligence actually we saw continued to be a top market theme during the last quarter, that is 2025, and we saw that technology related investment actually grew by about 14.01% for that is year over year in Q2, which is the second consecutive quarter and the fastest pace in the late since the late 1990s. Okay, so and when you talk about artificial intelligence, the spending here is mostly tied to the AI industry build out, with billions of shillings being spent on high performance computer chips, cloud architecture, data center constructions, and the the power and cooling need to run it all, because again, it's important to the power is needed, cooling is needed to run all these data centers, all right, and industrial build outs. So the spending actually boom became a significant contributor now to the economic growth, which really helps so much in terms of offsetting the softness in rate sensitive areas such as housing, manufacturing, and non-AI investments. Okay, so we have been seeing that boom in AI uptake. All right, so so while investors are now viewing AI as a multi-year cycle rather than a one of spending burst, a more balanced conversation actually is needed around the AI, and is actually it has started taking place. So right now we are also almost in that era of even having the AI music production. We have seen a lot of AI applications or softwares coming up that using them you can even create some music, your own music. So we anticipate AI musicians to start rising. Okay, so that shows how AI is really shaping the industry, not only the financial industry, all industries right now. Okay, so the reason why you see most of the companies are trying now to position themselves accordingly, because basically to adapt to those AI softwares. All right. So some questions about maybe probably whether spending is outpacing potential revenue, and how is really important for us as investors. Okay, because these concerns have actually triggered a periodic volatility, but they haven't really derived the broader narrative of the AI to continue as a key driver of corporate earnings growth and economic growth, as well as the market returns. All right. So if probably we shift our sentiments maybe to the equity markets. We saw the stocks rally to new all-time highs as market leaders broaden. If you look at major indices, like I've shown here, the S&P 500, it's in its all-time high. If you look at NAS 100, we are seeing them rallying to all-time highs. All right, so this is NAS 100. So we saw a very robust Q4 plus, actually gaining. I mean Q3, we saw NAS 100 gain about 8.64%. If you look at the US 30. Okay, if you look at the US 30, that is the famous Dow Jones. We're also seeing a very strong Q4. We saw a very strong Q4, about gaining about 5.16%, and also in its all-time highs. If you look at maybe probably FTSE, we are talking about FTSE. This is a future. Let me look at it in terms of not the future. I want the index. Right, I want the index. I want the index. Why is it not coming? Why is it not coming? All right, so you can see it here. So we are talking about also in its all-time high, Q4, the price running to about 6.75%. Okay, so these cements the reason why we had that stock rally, or the equity market rally. So because stocks basically were able to climb. If you see Q3 2024, all these indices and also some of the stocks, they were able to rally in Q3 to create new highs or new all-time highs. Again, boosted by the Fed rate cut. All right, resilient earnings and continued uptick of AI. So the Fed rate cut marked a shift towards policy support and fueled optimism for a softer landing, and a scenario whereby we see the economy slows but avoids a recession. So trade policies was another tailwind for this stock market. and progress on deals with major trading partners, which reduced the near term risk of escalation. So basically, when you look at this, we are talking about S&P 500 gaining approximately 8% in Q3, and bringing its earnings at the moment for the yearly earnings. If you go back to S&P 500, right, S&P 500. So in terms of the yearly earnings, if you look at the yearly calendar, that is the 12 months, we are talking about 12.97% at the moment. Okay, so technology stocks basically remained a key driver for these. But when you look at the small caps now, on the other side, if you look at the small cap stocks, they rallied sharply in anticipation of the Fed rate cut. We saw the Russell 2000, right? So that is the Russell 2000. Let me get it on the chart. Russell 2000, right? Russell 2000. So you can see it's also really pushing on the upper direction. Yearly gains, you're talking about at the moment 12.44%, right? So quarterly, we are talking about this is a 3 month data. We are talking about Q4 about 11.74%. So and actually it was able to surpass its highs here during this quarter, because the highs here since 2022 around I mean 2021, it had the highs here. So in Q3 it was able to surpass those highs and create another all-time high. So this is another sign of market optimism, because you are seeing also the cyclical sector broadly outperformed their defensive counterpart. So if you look at the sector breakdown now, so we see we were able to see the cyclical sector actually being able to perform quite good. So in terms of the international stocks performance, they were basically in line. They performed in line with the S&P 500, whereby emerging market outperformed the US stocks, and this was basically driven by the renewed stimulus of the renewed stimulus of efforts in China, and strong gains from AI-related companies in Asia. So also we saw the Fed's decisions to resume its rate cut cycles, providing another tailwind, as emerging markets like US small caps, they are often viewed as more sensitive to rate cuts and shifts in global financial conditions. So, in contrast, developed markets outperform the US stock. So, if you look at the European equity, it ended the quarter modestly higher as consolidated gains from earlier here. I mean, early this year. So, and despite the quarter's mixed returns, both emerging and developed markets, they were able to gain more than, I think, about 25% year to date in terms of returns. Okay, so basically what you're trying to say here is the two indices are each outperforming the S&P 500 by more than 10% since the start of 2025. That is the Russell 2000, okay, and the FT FTSE, right? So basically that's some of the key basically in summation, some of the key outlooks for the month of for the Q3. So some of maybe probably if we look at some of it in terms of challenges, some of the challenges we are seeing for Q3 is there was the stickiness of inflation remaining sticky, which was enough to keep the Fed cautious about being too aggressive in easing. We saw it reached a point until the president of the United States started to um, uh, to, 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 to create some turmoil between the Fed and the government, because he was so much pushing for the rate cuts. All right, so the labor market, also the softening of the labor market, which was able to raise the specter of weakening growth ahead. We also saw the trade and tariffs uncertainty that still loomed, even though this really persisted in Q2. That's where there was major volatility. In Q3, we saw that some of the worst fears had started easing because there were some deals that were made. There was some consensus that were reached. So, and importantly, and now the increasing risk of a U.S. government shutdown, which started immediately at the end of Q3, so transitioning to Q4, and it has begun to creeping into the narrative later in quarter. We saw it starting creeping in the narrative later. In that quarter. So now, when we look at Q4 2025, what are we anticipating? What are the key themes? What are the risks that we are looking at? Okay, so that is the bigger question that we want to look at, so that we can be able to be in a position whereby we are able now to look at ourselves or position ourselves accordingly. So one of the key themes that I see taking fold in 2025 is the rate cut and the central bank policy, because the market broadly expect additional Fed cuts. I think that was mentioned even during the previous Fed meeting. Also, Jerome Powell mentioned about it. In the symposium, Jackson Hole symposium, and we are expecting to see at least two rate cuts in 2025, by end of 2025, even as we see the inflation trends downward and growth slowing. So what basically is important for us to monitor in this scenario, for us to be able to be at a point, very nice point, basically to take advantage of this kind of data. So what we are basically what we might want to monitor as traders is basically watch upcoming inflation data, that is the CPI, PPI, PCE, and labor data releases closely. I know right now we're in the government shutdown, so this kind of data might not be able. We are seeing them being postponed. Of course, we didn't have the NFP this month. We didn't have the CPI. It has been kept pushing forward, of course, until now, and the government opened up. So when the government opens up, it will be very crucial for us now to monitor the inflation data, the labor market data releases, and also the Fed communications. That is the minutes, the speeches. Of course, we've been listening to the speeches. Even yesterday, we had the speech by Jerome Powell. So it is very important to listen to these speeches because they shed a light in terms of whether we are going to see a hawkish sentiment or a dovish sentiment. So if data surprises to the upside, then once the government resumes and we see data surprising on the upside, therefore the cuts could be delayed. Okay, so the other theme that is currently running now is the government shutdown and the fiscal drag. Okay, so we are talking about now we're on the 15th day since the government shut down. So, and the potential impact here is that a prolonged shutdown could meaningfully put a lot of weight on growth, as federal wages are delayed, because the delayed wages are basically permitting are likely to cause some disruption to agencies build up. All right, so that delayed of this key data is also actually causing uncertainties in the financial markets and creating a lot of volatility in the financial market. So what we should be monitoring is the duration of the shutdown, which is very critical. So we need to monitor the Congress progress, also look at the statements from Treasury, and also weekly indicators of federal workers and contractor stress. Also, it's important to watch for data blackouts. That is when now agencies post when agencies are posing the reporting, because right now they have really posted. Actually, they have started. They have posted the reporting. We haven't had the NFP. We hadn't had the CPI. It has been postponed. Okay, so it's also important. Another key theme to look at is the earnings and valuation risks. So we are now entering into the Q3 earnings report. Remember, we're in Q4, so we expect to see the Q3 earnings report. So with much of the market gains driven by optimism, a disappointing earnings season, especially in tech or even in more cyclical sectors, could basically trigger some a downside. Okay, so what to monitor in Q4 in regards to these? Monitor the Q4 earnings guidelines, the margin pressures, that is the wages and the input costs. Also, it's important to look at a rotation from high multiple growths, maybe probably to value or defensive, maybe in play in case this continues to prolong. So we might, in case the government shutdown continues to prolong, we might be able now to shift from maybe to shift to the defensive sector. Okay, so another theme, now that we have the government shutdown, it's also important to look at it in terms of data being post, right? So that is being post. So if the shutdown disruption delays delay, therefore we might be able to see a continued suspension of key data like the employment, the CPI, etc. And both markets and the Fed may make decisions with less visibility, increasing which might be able to increase the volatility. Also, was reading another article purporting that maybe probably the Fed might be caused to maybe print more money now to be able to service the government activities, but not really confirmed the reports, all right? But there was some speculation about that. So again, what to really monitor is we need to access the Bureau of Labor Statistics, census, or other agencies that report that their reports are at risk. So again, using high frequency proxies, for instance, the private surveys, the real time indicators, basically to fill in. So it's important to monitor that because the longer the data is being posted, the more uncertainties it's causing in the financial markets. Okay. Another key theme is the geopolitics or the geopolitical tensions, trade and policy risk. It's very important also to monitor that. So there are some renewed tension in trade or geopolitical fronts, which could likely shift the sentiment quickly, especially if policy surprises emerge. For instance, we have been able to see Donald Trump renew the US-China trade tension, right? So right now there is a lot of high tension. The Japanese basket is rising because it's being regarded as a safe haven at the moment. So this is also causing a very high uptake of gold. We're also seeing metals, not only gold, but also the metals, the commodities, metals to be specific. So we see the prices of gold rising. We see the prices of copper rising. We see the prices of silver rising. Okay, we see the prices of platinum also in the rise. Okay, so these geopolitical tensions, also we have been able to see an eruption of increased tension between Russia and Ukraine. So basically, if we look at all these geopolitical tensions and the trade policies, basically for traders, what we should watch out for is the announcement on tariffs. Right now, we are talking about the November 1st deadline between the US and China, whereby Trump said that he is going to implement 100% tariffs on China. Okay, so it's good to monitor, to watch out for those announcements on tariffs and trade agreements, sanctions, and global developments. Okay, so like maybe probably in China, in the US, in Europe, because they will really cause some shift in the markets or some volatility in the market. Also, it's important to monitor the proposed fiscal policy changes or stimulus in the US. Okay, so it's important to monitor that. Right. So maybe going back to the government shutdown, because we need to really look at these in different scenarios. And there is the moderate scenario, or which I might call the base scenario, whereby the government shutdown gets resolved maybe probably mid October. Of course, you're in this mid of October. So in case maybe probably during the this week we see that the shutdown being resolved, so this will allow a rebound in data and activities. And also the Fed might manage one or two cuts, right? So equities might grid higher, but they might lack that explosive upside, and the volatility might remain elevated. But now on the downside, that is in case we see a stressed scenario whereby the government shutdown drags into November, that is 4 weeks plus. What we might really see is some notable drag to GDP, some stalling corporate activities in sectors dependent on government contracts or regulation. Also, we might be able to see induced greater uncertainty in the markets, and the Fed might hesitate in terms of cutting the rates, because also we might see a very weak earning season or data shock, which could trigger some pullbacks or rotation. Okay, so on the other side, looking at it in another scenario, maybe what I might call a bullish scenario or an upside scenario, if we see rapid resolution to the shutdown, therefore inflation might fall more quickly than expected, and these might lead to greater confidence in multiple rate cuts. So markets might rally, particularly in growth and tech, with momentum extending into year end. Okay, so but the third scenario, it's not really likely, because right now we are on the third week of the rate cut. Okay, so now what you are looking at is the base scenario. If they work out, maybe probably within this week they resolve that. Or if that is not possible, we might go to the stressed scenario, whereby we see that the drag in government shutdown, which might cause a notable drag to GDP, and now stalling corporate activities in sectors dependent on government contracts and regulations, and also now inducing greater uncertainty. And we might be able to see now the Fed also hesitate in terms of cutting rates, and a weaker signal that may come in, which could trigger some pullbacks or rotation. But of course, now we are looking at, in case that happens, we are looking at the safe havens like gold continue pushing higher. So if you look at currently now the prices of gold, we are talking of gold right now, 4,213, right? So it's really pushing up, 4,213. In Q3, we are able to see the price of gold gain about 16.8 percent. All right. So that's what we are really, that's what I am looking at for this particular quarter. So before I sum it up, it's maybe I can put some stressors in terms of what you are anticipating in Q4. So I anticipate the Federal Reserve policy will likely to dominate the headlines in Q4. Maybe to reiterate on that, because in the Fed September rate cut, which ended the ninth month pause, but policymakers have really signaled, from the speeches you have seen from the central bank governors, they have really signaled a gradual easing rather than an aggressive one. So the market right now forecasting or priced maybe probably two more rate cuts by end of 2025, right? Though this outlook could shift if inflation accelerates or the labor market stabilizes. Okay, so in that essence, therefore, what you're talking about, Q4 is set up to be a very data dependent quarter, with the jobs, inflation, consumer spending, all impacting the market and the economic outlook. If we look at the corporate earnings, this will be another key area of focus. All right, now maybe probably putting in some more stressors here. So each the earnings have really proven surprisingly resilient this year, with Q2 earnings season producing solid growth and high bit rate, despite tariff volatility and policy uncertainties. The Q3 earnings season begins begins to come out in mid-October, and management guidelines will be key as the companies update investors on the impact of tariffs and their 2026 outlook. So that's what we are looking forward to mid, of course, mid this month. We are in that mid of the month. So if you look at the earnings report, maybe I can drag this. So, like for instance, this week we have been looking at JP Morgan Chase, which have reported their earnings. Again, this is the revenue forecasted. This is the actual revenue. So Johnson and Johnson have reported. So Bank of America is expected to report this week. Wells Fargo and Company, Morgan Chase, Stanley, Goldman Sachs. I think Wells Fargo has reported. Goldman Sachs have reported. So most of the banking industries have reported their earnings. Citigroup has reported. BlackRock has reported. So it's gonna be a busy start of Q4 for the earnings report. So in terms of AI related capital investments, they also remained a major theme in Q4 2025. Companies are reporting unfilled orders switching into 2026. And if you look at the capex plan, basically measuring in the hundreds of billions, again reinforcing the view that AI will be a multi-year investment cycle. However, if we look at the valuations of for AI companies, they are a bit expensive, and much of the backlogs and spending plans are widely known and already reflected in the stocks market. Okay, so in case we have an earnings disappointment or skepticism around the AI economics, this could weigh on the technology sector leadership and probably by extension the broader equity markets. Okay, so that's maybe how I'm looking at things in 2025. So for gold, because I'm very key, Adam, a key fan of gold, I usually trade this metal passionately. So like I've been mentioning, I'm looking at probably 5,000 by Q5, right? 5,000 by Q4. That is by end of this year. Maybe probably might clock 5,000 levels, all if not maybe probably 4,400, 4,500, and maybe probably in Q1 2026 now will clock in the 5,000 levels. Okay, so because right now metals, especially gold, silver, they are very bullish. Okay, so I was reading another article here even as I wind up. This was an article basically it says the title is that metals are on fire. Gold 4,200, silver right now it's not actually 53. All right, we can confirm that silver has really pushed up. Right, so this is silver. So right now we are talking about 53 levels. All right, so it had reached a high of 53.579, so it has really pushed up. So if you look at maybe probably platinum, right, so we're talking about 1,700. So that is a platinum, right? Platinum, platinum. All right, so this is platinum. So if you look at platinum, we are talking about the highest level, 1,1686. So we are talking of prices rallying maybe probably even to 1,700, because it's almost to that level, right? So if you look at maybe probably copper as well, it's really doing quite good rebounding. We see a rebound of copper. Prices had dipped slightly, but we can see it had created a high of about 5.98. So right now the price is 5.06. So we are seeing that rebound coming back again, right? So the last 3 months, the last 2 months, that is September and August, have been bullish, and also we are looking towards a bullish October, right? So, but what really caught my attention here is how I mean, first of all, the drivers are why the metals are really accelerating. We are talking about the central bank demand. So we have seen gold holding continue rise, anchoring precious metal prices, because you have been able to see the central banks are really purchase or add their gold reserves. All right. So also the green transition, silver, platinum, and copper are key beneficiaries of the green transition of EV, solar, EV, that is electric vehicles, solar and hydrogen infrastructure growth. So there's also been supply deficits, that is mine output remains tight while demand expands, particularly for platinum and copper. So again, really pushing the prices of platinum and copper high. So the Fed easing and the weak dollar, as real yields compress, investors are relocating capital into real assets. Okay, so but some of the key things where I'm looking at, these are the institutional targets, how they are looking at, these are big institutions. So for instance, the Bank of America, they are targeting gold to reach 5,000 dollars per ounce by 2026. So the key theme here is they are citing the physical fragility, the reserve diversification. If you look at JP Morgan Chase, they are targeting the prices of silver between 65 and 70 by 2026, again driven by industrial and monetary dual demand. City Group, for platinum, they are targeting between 1,800 to 1950, again by the end of 2025. So here the key themes is the hydrogen economy, the auto catalyst, and the auto catalyst recovery. Goldman Sachs, they are talking about the prices of copper going to 13.0, right? So again, by end of 2026, again by 2026, I mean in 2026, again citing the AI infrastructure and the EV grid demand. Okay, so with that, that's quite insightful. All right, I believe you have been able to gain one or two things, how you can be able to position yourself now in the financial markets, irrespective of the sector that you're looking at. Maybe to repeat quickly, the key watch points and tactical angles for Q4 2025. We are looking at the shutdown resolution timeline. We're also looking at data resumption, alternative measures. We're also looking at the Fed communication and forward guidance. We're also looking at the earnings season surprises. We're also looking at the volatility regime and hedging. And all these cumulatively are going to cause some volatility in the markets, creating potential opportunities to position ourselves accordingly in the financial markets. Okay, so I believe you got some insights in this video. So make sure to like, share, subscribe, and also comment in case you have anything that you might want me to talk about. Make sure to comment and I'll be able to do that. So with that, I wish you a fruitful Q4 ahead. All right, so we're already almost a half of the first month of the Q4. So but I wish you a fruitful one. For gold traders, I know we are smiling, we have been bagging this metal. So make sure you secure the bags, and see you at the top.